Hey, Get Rich Education Nation, Keith Weinhold here. We're on a summit for real estate on a cruise ship, and I'm with Hannah Hammond. She's the founder of HB Capital, a commercial real estate lending firm, and the effervescent host of the Hannah Hammond Show. Hey, it's great to chat.
You too. It's been so great to get to know you on the ship, and it's been a lot of fun.
And we just met at this conference for the first time. Hannah just gave a great, well-received presentation on the state of the commercial real estate market. And the most interesting thing, and the thing everyone really wants to know, since she lends for 5+ unit apartment buildings as well, is about the commercial real estate interest rate resets. Apartment building values have fallen about 30% nationwide, and that is due to these resetting loans. So tell us about that.
Yeah, so there is a tidal wave of commercial real estate debt coming due in 2025. Some of that has already come due, and we've been seeing a lot of the distressed assets start to hit the market in various asset classes, from multifamily, industrial, retail, and beyond. And then as we continue through 2025, more of that tidal weight of debt is going to continue to come due, which is estimated to be around $1 trillion in debt.
Yeah. That's huge. I mean, that is a true tidal wave. So just to pull back really simply, we're talking about maybe an apartment building owner that almost 5 years ago might have gotten an interest rate at, say, 4%. And in today's higher interest rate environment, that's due to reset to a higher rate and kill their cash flow and take them out of business. Tell us about that.
Yeah, so a lot of investors got caught up a few years ago when rates were really low, and they bought these assets at very low cap rates, which means very high prices. And they projected, maybe over projected, continuous rent growth, like double-digit rent growth, which many markets were seeing a few years back. And that rent growth has actually slowed down tremendously, and so much supply hit the market at the same time because so much construction was developed a few years back. And so now there's a challenge because rents have actually dropped. There's an overage of supply. Rates have doubled. You know, people were getting apartment complexes and other assets in the 2 or 3% interest rate range. Now it's closer to the 6 to 7% interest rate range, which we all know, it just doesn't really make numbers work. Every 1% increase in interest, you'd have to have about a 10% drop in value for that monthly payment to be the same. So that's why we're seeing a lot of distress in this market right now, which is bad for the people that are caught up on it, but it's good for those who can have the capital to re-enter the market at a lower basis and be able to weather this storm and ride the wave back up.
Income down, expenses up. Not a very profitable formula. Let's talk more about, from this point, how bad can it get? We talked about $1 trillion in loans coming due this calendar year. Just tell us about how bad it might be.
Yeah, so it's estimated that potentially 25% of that $1 trillion could be in potential distress. And of course, if $250 billion of commercial real estate hit foreclosure all at the same time, that would be pretty catastrophic, and there would be a massive supply hitting the market and therefore a massive reduction in property values and prices. And so a lot of lenders have been trying to mitigate the risk of this happening and all of this distressed debt hit the market at one time. And so lenders have been doing loan modifications and loan extensions, and the extend and pretend quote has been in play since back in 2025. But a lot of those extensions are coming due. That's why we're feeling a little bit more of a slower bleed in the commercial market. And, you know, in the residential market, we're not seeing as much distress because so many people have those fixed 30-year rates. But in commercial real estate, rates are generally not fixed for that long. They're more, they could be floating debt, or they might only be fixed for 5 years and then they've reset. And that's what we're seeing now, is a lot of those assets that were bought within the last 5 years have those rate caps expiring, and then the rates are jacking it up to 6 to 7%, and the numbers just don't make sense anymore.
That 1 to 4 unit space, single family homes up to fourplexes, has stayed relatively stable. We're talking about that distress in the 5+ unit multifamily apartment space. So Hannah, when we pull back and we look at the lender risk appetite and the propensity to lend and to want to make loans, of course, that environment changes over time. I know that all of us here at the summit, we learned from you in your presentation that that can vary by region and the loan to value ratio and the other terms that they're talking about giving. So tell us about some of the regional variation. Where do people want to lend and where do people want to avoid making loans?
Exactly. And we were talking about this, is every single region is so different, and there's even micro markets within certain cities and metropolitan areas, and the growth corridors could have a very different outlook and performance than even in the overexposed metro areas. So lenders really pay attention to where the capital is flowing to. And right now, if you look at U-Haul reports and cell phone data, capital is flowing mostly to the Sun Belt states, and it's leaving the Rust Belt states. So this is your Southeast states, your Texas, Florida, Arizona, and these types of regions where a lot of people are leaving some of the Rust Belt states like San Francisco, Chicago, New York, where those markets are being really dragged down by all this office drag from all the default rates in these office buildings that have continued to accumulate post-COVID. So the lender appetite is going to shift market to market, and they really pay attention to the asset class and also the region in which that asset class is located. And this can affect the LTV, the amount of money that they're going to lend based on the value of the property, also the interest rate and the DSCR ratios, which is how much above the debt coverage the income has to be for the lender to lend on that asset.
So we're talking about lenders more willing to make loans in places where the population is moving to. Florida, other markets in the Southeast, Texas, Arizona. Is that what we're talking about here?
Exactly. And even on the equity side, because we help with equity like JV equity or co-GP equity on these development projects or value add projects. And a lot of my equity investors, they're like, nah, not interested in that state. But if it's in a really good Sun Belt type market, then they have a better appetite to lend in those markets.
Was there any last thing that we should know about the lending environment? Something that impacts the viewers here? Maybe something I didn't think about asking you?
I mean, credit is tight, but there's tons of opportunity. Deals are still happening. CRE originations are actually up in 2025 and projected to land quite a bit higher in 2025 at about 665 billion in originations versus 539 billion in 2024. So the good news is deals are happening, movements are happening, purchases and sales are happening, and we need movement to have this market continue to be strong and take place, even though unfortunately some investors are going to be stuck in that default debt and they may lose on these properties. It's going to give an opportunity for a lot of other investors who have been kind of sitting on the sidelines, saving up capital and aligning their capital to be able to take advantage of these great deals. Because honestly, we all know it's been really hard to make deals pencil over the past few years. And now with some of this reset, it's going to be a little bit easier to make them pencil.
Oh, this is great. Loans are leverage. Compound leverage trumps compound interest. Leverage and loans are really key to you making more of yourself. Hannah, if someone wants to learn more about following you and what you do, what's the best way for them to do that?
At Hannah B. Hammond on Instagram. My show, The Hannah Hammond Show, is also on all platforms: YouTube, Instagram, Spotify, Apple. And if you shoot me a follow and a message on Instagram, I will personally respond to you and would love to stay connected and help with any questions you have in the commercial real estate market.
Hannah's got a great presence and she's great in person too. Go ahead and be sure to give her a follow. We'll see you next time.
Thank you.
You can watch this one next.